Well, welcome to the show. Want to just introduce yourself, who you are, what got you into the financial industry, and what we'll be talking about today.
For sure. So my name is Logan Reiter. I've been in the financial services industry for just over 10 years. And what got me into the industry was coming out of university. My major was accounting, my minor was finance. And I wasn't sure what I wanted to do, but met with a few people in both the accounting world and in the finance world, and found that finance was the place that I wanted to be through a number of conversations. And then I kind of got passionate about correcting some of the injustices in the financial industry, and that's really kind of what got me locked in to want to.
So how old were you when you got out of university?
23.
23?
Yeah.
And would you say that, just kind of, so you didn't do any other work coming out of university as a professional before you ended up in financial services?
No.
No, you entered straight into it.
Correct.
And so then when you got started, you said minor in finance and major in, what was the major again?
Accounting.
Accounting. Did those degrees prepare you for the actual financial world at all?
No.
No?
No, not at all. Fortunately, I got to play basketball in university. That prepared me more for the real world than the actual studies themselves. Just working in a team and building relationships and that aspect of things, and the discipline and work that had to be done in that arena.
Coaching played a big part of that, I imagine, eh?
Yes.
Yeah.
100%.
So when you say that the classes weren't useful, was it that it was like just bad information or just lack of information?
Yeah, just lack of relevant information or practical real world application. There's definitely some stuff that can be used for sure, but as far as, especially in the financial industry, there was very, very little that actually was relevant to like personal finance and how to manage your own financial household. And that was a huge gap that I saw, and that was part of why I wanted to get into this industry, because I thought, well, if I have a degree in accounting and finance and I didn't even learn how to get myself financially secure, then what does that say for the average person?
Yeah, well, and I remember the first time I heard the idea of becoming financially independent. The first time I heard that, I had run a business for 15 years before I ever heard that, right? And I was 34 years old first time I ever heard that, that term, financially independent. And even that by itself was like, that opened up a whole different world of things and thought patterns in terms of finance, right?
Yeah.
So you would say that was never talked about in university?
No.
In the coursework that you did? And maybe there are areas where they talk about it, but certainly not in your experience, eh?
Not at all. And like you said, the word financially independent, or the phrase financially independent, it has a definition.
Yeah.
And
define it for us.
Financial independence is when your recurring income exceeds your living expenses. And that can come in a number of different ways, right? It could come from property, it could come from a business, it could come from investments.
Retirement funds.
100%. And so there's, the definition is fixed, but the way that you get to that end goal can vary, right?
When you, and just so we can get that out there one more time, is when your recurring income is higher than your expenses.
Correct.
Per year or per month, however you want to word that.
Exactly.
Yeah. No, I agree with that term. I think that's a fantastic term to use. So we're going to dive into the financial service industry specifically today. We're going to talk about a bunch of different products. Before we dive into specific products, you have a philosophy and a thing that you say in terms of insurance products. Tell us what that is, and then we'll dive into that. In terms of term insurance versus permanent insurance specifically.
Right. So in the life insurance world, generally speaking, people put the different types of policies and products into 3 different buckets. They'll put, one bucket will be term insurance, which is just simple protection for a fixed amount of time, fixed premium. This is typically how that works. The second bucket would be whole life insurance, traditionally maybe known as cash value insurance. And then the third would be universal life insurance, which is kind of looked at as almost a combination of the two in a sense, with a little bit more flexibility than a whole life. But my philosophy is that all insurance is term insurance, and I mean, that's just a fact when you actually study the policies. They're all term insurance. It's just some policies attach on a savings component, and that can look different depending on the policy.
So that, just that little bit there would get a lot of people pretty riled up, because there are policies that guarantee a death benefit no matter when you die. Therefore, that is permanent insurance, right? So tell me why you believe that specifically is still term insurance.
Because inside the policy, the actual insurance component is always term insurance. So for example, whole life insurance typically is going to essentially be a decreasing term to age 100 insurance policy with a savings account attached to it. And so it's really just a term to 100.
So basically you're funding your own death benefit inside the policies.
Correct.
To supplement the decreasing term policy that they have built into it.
Correct.
So when they say there's a guaranteed death benefit, no matter when you die, there is always money that they're going to pay out. But if you die after your term policy expires inside that whole life policy, as an example, they're basically just giving your beneficiaries the money that you accumulated during your contribution period, during the time that you put money into it.
Correct.
Right.
So the amount of insurance that you have inside of the policy decreases proportionate to the amount of cash value that you have, if that makes sense.
So like in simple terms, by the time you die, it's your own money that you're being paid back, not the actual insurance money.
Yeah. When you look at it from a business perspective, from a life insurance company, if you live to age 100, at that point, technically the life insurance company should have zero liability. Your cash value is your death benefit.
Because they are set up so that your cash value specifically is equal to your face value, which is the coverage amount, your life insurance coverage amount at age 100.
Generally speaking, that's the
generally speaking.
And sometimes it's even sooner if you overfund it.
Yeah, and so we'll get into all of that,
Yeah.
that little, the nitty gritty of it, and run down some rabbit trails and see how these things actually work and talk about that. But just overarchingly, that's the statement that you live by. So therefore, what your ideology behind that then is, if all insurance is term insurance, why not just separate the two then, so that you can have term insurance as long as you need it, and then become financially independent so that you have no need for insurance, because all insurance is term insurance.
Yeah.
Right.
So
That's kind of how I'm hearing that, right?
Yeah, the overarching thought process, and I think that the conversation gets convoluted because people don't look at it this way. The question shouldn't be, well, what kind of life insurance should I have? The question should be, what kind of investment vehicle should I use? Because I can either buy a term policy and invest the difference into my choice of savings or investment vehicles. Could use a myriad of different options for that. Or I can buy a term policy and put the extra funds inside that policy in either a whole life policy or a universal life policy. So the question really becomes, what's the best way to invest your money? Because no matter what, you're buying term insurance.
Yeah. So now what else are you investing in? Yeah, that's the question. Right?
Exactly.
And would you say these whole life insurances or universal life were meant to be investment vehicles?
Absolutely not. I think that insurance companies are very explicit about that, actually. It's just the salespeople that are not.
Yeah, and I think that's actually something interesting. We should probably talk about that a little bit before we dive into any of the specific policies and how they work. Is insurance companies specifically have it on their website and in their advertisement, in any kind of brochures that they have, that insurance is not an investment, right?
Correct.
And yet a lot of people that meet a sales agent for these, let's call them permanent policies, when they sell them as an investment tool. Yeah. And so where do you think that that information breaks down, from the company to the agent, or from what do you think that breaks down, in your opinion?
I think that the sales training that the industry often provides is where that breaks down. So, because legally, this is just based on regulation, the insurance companies have to say that all dollars that go into a life insurance policy have to be for the purpose of life insurance.
Yeah.
We've got countless times where insurance companies have been quoted explicitly saying that. As an example, there's an article in the Investment Executive. You can attach it in the notes on the podcast here, but just two quotes from the same article in regards to a lawsuit talking about permanent policies. One of the quotes is, this insurance company has always maintained that the position taken was illegally founded in the life insurance contracts, so all life insurance contracts, were never intended to be used as deposit accounts and for purposes unrelated to life insurance. So if your purpose is to build wealth and grow your investments, legally the life insurance company says that's not the purpose of any life insurance policy. So that's where it comes in. Well, why is it being sold that way?
So that's the underwriters basically saying that, or not just the underwriters, but the insurance company that hires the underwriters. So your belief is that it gets broken down in the training of the sales representatives for that.
That's the only conclusion that I can come to. Same article, I'm going to read another one that just even hammers it home even further. So this article is talking about a class action lawsuit in regards to permanent policies and the investments inside of them. And it says the decision in this case confirms that policyholders cannot make unlimited deposits into universal life insurance contracts, and makes clear that deposits must relate to amounts required to pay the life insurance premium. So basically, any dollars that you put into a insurance policy must relate to future cost of insurance.
Yeah. So when I am an agent for these things and I sell it to you and I say this is a tax sheltered savings account, I'm actually saying something different than what the company is saying.
Correct.
Yeah.
And the companies have to say what they do say from a compliance standpoint.
Yeah.
Whereas the agent, they can say whatever they want
To get
as long as it's not being recorded or left behind.
That's true. Yeah.
And there have been situations where they have been recorded or had stuff left behind with clients that did not match the compliance side of things, and that's where we see lawsuits historically in the life insurance world, is when there's a misrepresentation of what these products are designed for and what they're actually going to do.
Yeah. So okay, let's dive into the whole life specifically. Or sorry, let's talk about cash value. So we talked about there's cash value, which is a permanent policy, for lack of better terminology, at this table, and then there is basically a universal life insurance. So a UL and cash value are really the only two type of policies out there other than term. There's a whole bunch of different spin-offs off of that. They call them infinite banking, become your own bank. What's the other one? It's been sold as an RRSP, RESP. It's been sold as an RRSP. It's been sold as a tax-free savings account. What was the other one that we came across here recently?
Insured retirement plan.
Insured retirement plans. None of those things are true. They're all basically an IUL, a UL, or a cash value whole life policy.
Correct. Actually, the newest one is a personal tax shelter.
That's right. Yeah.
Yeah, that's another one.
Yeah. Or estate plan. This, that, and the other thing, right?
Yeah.
So, and then one of the other things is we should probably talk about that before we get into the cash value specifically. I've heard it said on a number of different occasions that it helps to mediate the probate problem if somebody dies, right? Talk to us a little bit about that, because I know that registered accounts, your personal residence, as long as there's a registered beneficiary, it doesn't go through probate anyway, it goes through the beneficiary, same as a life insurance policy regardless, right?
Correct.
So let's talk about that for just a couple of minutes, right? So the probate problem really goes away when you think that through.
Yeah, so if you have a spouse and you pass away, everything should just flow straight to your spouse with no issues whatsoever. It's when assets are going to flow to the next generation or beyond, like if the spouse passes as well. As far as probate goes, in Alberta, the cost of probate is literally
I think it's like
For sure.
$50 under
Under,
200,000
yeah.
or something like that.
The maximum is like $500 or something.
Yeah.
The cost of probate.
Yeah.
And then the other side of it too is oftentimes permanent life insurance
Yeah.
is sold as a way to pay your estate taxes.
Yeah.
That's what you'll often hear, right? You'll say, well, this policy, you need this permanent policy so that when you die, the taxes on your estate will get covered by the life insurance policy, because life insurance pays out tax-free. Now, the issue with that is that in Alberta, there is no estate tax. It
Mhm.
doesn't exist. So it's just, and you're just scared, it's a scare tactic,
Yeah.
right? Saying, hey, you're gonna have all these estate taxes. Well, the problem is that if I, as a good financial advisor, don't help someone build wealth, there is no estate in the
Pay
first
tax
place.
also.
And secondly, there is no such thing as an estate tax. Now, there are taxes on the assets, which are gonna have to get paid no matter what,
Mhm.
whether that's capital gains taxes or taxes on RRSP accounts, but there are no actual estate taxes, right? There's some places in the US specifically where that is a thing. If you have a huge estate, there's gonna be taxes on
Yeah.
top of the capital gains, but we don't have that in Canada, or at least in Alberta.
Well, and just even to address that specifically, a lot of the information that comes through social media flows from the States, right? And there are a lot of misconceptions.
Yeah.
That
But why
flow-
are Canadian life insurance or Alberta life insurance agents
talking about
talking
that.
about that when it's not a thing?
Yeah.
So when proposing these products, they make it sound like it's this big problem that they're solving
Yeah.
for you. When in
Correct.
reality, worst case scenario is $50 for 200 grand. And after that, I think it said it was like what, just a couple hundred
Yeah,
bucks.
a couple hundred bucks.
Yeah.
So it's like, yeah, so it's not a lot. It might be a couple of thousand even. Let's even say it's 5,000 or
Yeah.
500,000 a state.
Yeah.
Or whatever.
Right.
The life insurance can't be sold on the basis or on the merit that you're solving some sort of a big financial problem for the next generation in terms of
Correct.
probate, right?
Yeah.
And then even if you think about just, and I know that you've made this comment before, and we'll talk about it a little bit more in terms of cash value, but with the opening or with the legalization of a tax-free savings account, cash value specifically should have died, right?
Yep.
But a tax-free savings account as an investment vehicle, for example, if you put your spouse on as a beneficiary or as a successor holder, the only thing that happens to that account is the name changes,
Correct.
right? So your spouse gets that as soon as you give them a death certificate and file some paperwork, the money flows directly into, doesn't even flow into their account. They just become the owner of that account. No probate, no nothing to go through, right? So the whole idea behind that probate, you're solving a probate problem by selling a quote unquote permanent policy is just not true.
Correct.
Yeah.
It's completely untrue. And on top of that, with tax-free savings accounts, if you pass away, your spouse takes over the account. If your spouse passes away, it goes to the next generation tax-free.
Mhm.
There's no tax on a tax-free savings account,
Even if it goes to the next generation.
on death.
Yeah.
And so, if utilized properly, like if a household has not completely maxed out all of their registered accounts that are available to them, RRSPs, tax-free savings accounts, if they qualify for a disability savings, education savings plans, if those aren't all completely maxed out, topped up every single year, the conversation of permanent life insurance shouldn't even be brought up in my mind, simply because those registered savings vehicles are untouchable by any life insurance product. And yet the majority of people who are sold these products, they may not even have a tax-free savings account. In fact, there was some data that came out a couple of years ago. I can't remember the exact percentages, but a very large percentage of people who are being sold universal life insurance policies don't even have a tax-free savings account,
Yeah.
which is mind-boggling to me.
So if you take as an example, $500 a month into your regular market rate of return, say the S&P 500, and you do that for 30 years, by the time, say you start at age 30, you go to 65, you've got somewhere around $1 million tax-free savings account, right? That passes on to the next generation completely tax-free. How does that still warrant somebody selling you a permanent life insurance policy? an expensive one, I may add, right?
It doesn't.
It doesn't, right? And so let's talk about that. And this as an example, we say that with the legalization of a tax-free savings account, the cash value one specifically and especially should have died, and we know that it hasn't, and that's in large part due to the high commission that's paid to the agents.
I would say
Right.
it's exclusively due to
Yeah.
the high commissions and the profitability to the insurance
The
company.
profit, yeah. So let's talk about that then. Cash value specifically, give us the couple of different types, how they function, and what the cost of them would be. Let's talk about that a little bit.
So in a typical, I mean, anyone can go online and actually run just free quotes for themselves. But if you go to termforsale.ca,
Yeah.
TERM, the number 4 sale.ca, you can run quotes for yourself if you're curious as to how much more different types of policies are going to cost versus term, and you can run those quotes and you can see different insurance companies' rates, and you may not see all the benefits of each policy on there, but you'll be able to see rates. So for me, when I first was getting my financial house in order, I got quotes for all 3 major types of insurance.
Oh, you did the UL as well?
Yeah, I got quotes for term, a 35-year term at that time, because my wife and I were in our 20s, and so we wanted a 35-year term so that we had, at least coverage into our 60s, which was important to us. So we compared a 35-year term to a just regular indexed universal life insurance policy versus a whole life policy or cash value. And our term policy, we have $2 million of coverage on a 35-year term, 1.25 million on myself, 750,000 on my wife, and on a 35-year level term, that costs us $147 a month. That's what we pay. In comparison, the cost for whole life was just under $900 a month, and the cost for universal life was about $750 a month for the same coverage.
So you were actually comparing apples to apples.
Correct.
Yeah.
Same coverage. And that's where you start to figure out, okay, if I'm paying $147 over the next 35 years, if I choose to do that, how many dollars a month, if I invest that difference in cost, how much is that potentially going to be worth 35 years from now, and is it greater than the death benefit of the life insurance over time?
And so just for clarification, for the sake of this conversation, when we talk about investment specifically, we'll talk about like an equity mutual fund portfolio.
Sure.
Right? Yeah, let's do that. Because there's one of the things that you get comment on, but there's a bazillion different ways to invest, and some of them, a GIC will grow at 2%, so it's obviously not true. So for the sake of the conversation, when we're actually comparing, when we're talking about whole life policies and the rate of return we can get on investments, we're talking about an equity mutual fund portfolio, a good equity mutual fund portfolio that grows at least 9% per year.
We could even just use the S&P 500 as a benchmark.
Yeah, okay, let's do that.
Just to keep it simple.
Keep it simple. S&P 500 as a benchmark. Okay. So then if you talked about investing that difference at that rate of return, right? Yeah. Okay. So did you do the calculations on how much that would be if you invested that amount of money every month, that difference?
Yeah, and over the years we've continued to just increase what we invest, right? And so I think that's one of the most important things for people to understand as well, is that a lot of times life insurance policies get sold as a financial plan. You say this policy is everything you need. It protects you, it builds your wealth.
They put disability in there.
It's literally just a one picket solution to financial independence, but that is so far beyond not true. It's crazy. A good financial plan takes into consideration all aspects of
your risk capacity, your capacity to increase your income, your debt levels, all of that. Yeah.
And insurance, like we just read, insurance is not an investment.
Yeah.
by definition. The insurance companies state it explicitly. And so when it comes to planning our financial future, the whole idea that everyone should have is, how do I get completely debt-free and totally financially independent? Meaning that I have the ability to live off of the assets that I've accumulated. Those assets produce enough income for me that if I didn't want to work anymore, I don't have to.
Mm-hmm.
That's what everybody should be after. But that can't happen with life insurance. And a lot of times it's, there's a number of ways that these policies get sold that are not just deceitful, but just flat out lies.
Yeah, it's just not true.
Like, a lot of times they scare people with taxes. Nobody wants to pay more tax than they have to, right? Everybody, it's a universal thing.
Yeah.
Right?
Let's try and avoid taxes.
Yeah.
Yeah.
It's like, hey, if I can pay less taxes legally, I'm gonna figure out how to do that. That's what most
And
people
good
think.
for you, as you should. The loopholes are there for a reason.
Right.
If they want to call them that. The rules are there for a reason.
The rules are there for a reason, as long as I'm staying within the bounds of the tax code. But the problem is with life insurance, they're selling these products as either tax-free or tax sheltered or whatever they want to call it.
Yeah.
But in reality, that's a farce, because they probably don't understand the basics of how that tax code actually works and applies to life insurance. There's another article that came out actually pretty recently that is titled, "So Your Client Wants to Access Their Permanent Life Policy's Cash Value." And then it goes on to talk about how the ways that you can access the cash value. And this is one of the major issues with cash value, whole life or universal life, is how do you actually, if you have some savings or investments inside that policy, how do you actually get that money if you need it?
Yeah, so let's talk about that. It's specifically in a cash value, right? So there's basically, there's only a couple of different, how many different ways are there to access that cash once you've got some cash accumulated? First of all, many times it takes between 3 to 5 years to accumulate any money, right? But once you do have some, or you put a large sum in there, right? Once you have some in there, how does that work? How can you access it?
So you can surrender your policy, meaning then
Stop paying your premium, stop paying for it.
completely loses all the benefits that it was sold to you as. Surrender the policy, take the cash value, you no longer have the insurance, you just have the cash. But it's going to be taxable.
Yeah, in that form, it actually gets added to your income. I actually had that scenario. There was an older gentleman, he was 68 at the time. He had two cash value policies. Both of them had 50,000 face value, or their life insurance amount. And one of them had about 14 grand in it, the other one had about 12. One of them actually had a loan against it because he couldn't afford to pay it. So they were taking the money out of the cash portion to pay for the premium. And so it had a loan in it, and he cashed them both out. And it ended up going, they taxed him on it, and so he ended up with a large tax bill, but he had no income and no savings. So this thing that was sold to him as a retirement plan actually hurt him in the end, because once you have an income, some of your old age security benefits go away, right? And so it was a double-edged sword. On the one side, he owed taxes now, and because he owed taxes, he lost the support that he had from the government to begin with, right? And the problem that I had with it is that the policy was actually designed to do that, right? Yeah. And so that's what happened to him when he took that out when he got older. He just didn't pay the premiums anymore. They sent him his cash back, which was fantastic. Now he paid tax. I think he still owes a tax bill. This is 6 years later, because he's old, he can't afford to pay for it. It's just accumulating. He's like, one day when I die, the tax bill hopefully will die with me. That's his motto. That's actually his motto. Right. So good estate planning for that agent that's sold a cash value policy, right? But anyway, sorry, I totally went off track there. So that's the one way, but that's the result of that one way of cashing that out.
You can surrender it, and again, what those tax consequences will be varies from policy to policy based on the adjusted cost basis of the policy. There's no way to know what that'll be until you actually find out from the insurance company, and oftentimes it's very difficult to find out. The other way to access cash is to take a policy loan, which is, again, those can be even taxable.
Yes.
Which is crazy, because borrowed money is not supposed to be taxable, right? If I go to the bank and get a line of credit and take $10,000 and go buy stuff with it, that $10,000 isn't taxable because it's borrowed money. and yet policy loans can be, meaning I'm borrowing from the insurance company, my cash value stays there, I can borrow it, but again, the government can look at that and say, we have precedent for it, where they can look at that and say, hey, that's taxable.
Yeah, and that has happened. There are scenarios where that's happened.
Correct.
Yeah.
We have literal scenarios where it's happened. And on top of that, the death benefit gets reduced by whatever that policy loan is that you take out. So if I borrow money against my policy from the insurance company, a policy loan, and I die, my spouse or my beneficiary is going to get my face amount minus whatever the policy loan was.
Which is crazy because originally you're borrowing against your own money that you put in there, not even the insurance amount.
Correct.
Right?
Yeah, you're not borrowing against the policy, you're borrowing against your money.
But that
Correct.
still decreases the amount that you're covered for.
Yeah.
So when we look at, for example, the idea of infinite banking, right? Where it's like, hey, build up your own bank in this insurance policy, and then you can borrow from yourself. You're not borrowing from yourself. You're borrowing from the company. You're borrowing from the insurance company, and that's evidenced by the fact that when I die, someone's got to pay that back to the insurance company from the death benefit.
Yeah.
So I'm not my own bank. The insurance company is my bank.
Yeah.
That's what it is.
Yeah, exactly. And
Yeah.
so one of the things that it gets sold as, you can control and you can compound, right? You've heard that term as well, right? And so you can control the amount of money that you take out and you put back in with uninterrupted compounding growth inside the policy.
Right.
But yet, if I put in, and let's just use an example, if I have $1 million worth of life insurance coverage and I deposit $100,000 into the cash portion, they will loan me back, say, $600,000. So I'm immediately out my $400,000, right? And if I had the $100,000 in cash, I could just use $100,000 if I wanted to invest it into something else, right? But they will, let's say they give me back 60% on my deposit amount as a loan.
Yeah.
Now I'm borrowing my own money because it's my money,
Paying interest on it.
paying interest on it. I'm paying that to a different corporation. That interest doesn't go back to me,
No.
right? So now you've lost control of your own interest money. So that's not control. On top of that, if I died with a $400,000 loan against the policy, my beneficiaries would get $600,000, and that $400,000 would, or sorry, I used 100,000 and used 400, so that doesn't quite work. Sorry, use 40 as an
40.
example. Say 140, I would get $40,000 back. Sorry, they keep 40, I get 60.
Yeah.
That's how it works. Okay, finally got my numbers right. If I put $100,000 in there, I can borrow 60. That's how it works. If I borrow that 60, I'm paying interest to somebody else on that 60,000.
Correct.
So I've lost control of the interest. On top of that, if I die, that $1 million policy doesn't get paid out. That $60,000, which was my money to begin with, gets paid to the insurance company, right? So what happens to the other 40? Also goes to the insurance company, right? So my $100,000 is completely gone. So I've not only given up control of the interest, I've given up control of the 60 that I borrowed, and I've given up control of the 40.
And they might say, well, at least you can borrow against it. But can you borrow against just a completely separate investment account?
Why not?
Exactly.
Yeah,
So it's
so-
like there's really no point to the product to begin with. Because even though they say you can borrow against it, well, if you just have an RSP or a TFSA somewhere, you can still borrow against that as well, just through a bank.
If a bank is willing to use an investment account as leverage,
Right.
then I don't think they really care.
They're more likely to use an investment account as leverage than a life insurance policy.
Yeah, it's more like.
And that interest is probably even lower than you
It
would
is.
get with those insurance
You will
companies.
get a much better interest rate through an institution like a bank than you will through an insurance company. Insurance companies are not banks.
Yeah.
That's not what they are.
And they make that very explicit, right?
Correct.
So those are the three different ways of pulling your money out, right? Is surrender, and the third one, we need to talk about the third one. And
So yeah, the third one would be to borrow from a third-party institution,
that's right, yeah.
which isn't even accessing your money. You're just taking out a loan from a banker or a lender, right?
And so
That's
if you-
not at all
But again,
taking money out.
the control part there is lost because you have given your money to an institution, right? Which is technically now gone, because if you die, that money is gone in 99% of cases. We'll talk about the other one in a second. But now I also, because I deposited my money here, I also now have to go to a bank and loan money somewhere else if I need more cash.
And guess what? They have the first right on
Your life insurance.
your life insurance when
Yeah.
you die, because if you owe them, if you're using that life insurance as collateral for a loan, let's say I borrow $100,000 from the bank and use my life insurance as collateral, and I die, the bank's gonna say, that life insurance, we get our $100,000 before your
Because loan is
beneficiary.
signed over here.
Correct,
Yeah.
before your beneficiary gets anything. It's the same, a policy loan and a loan from another institution, in principle are the same. It's still, you're still borrowing money.
Yeah.
And I get the uninterrupted compounding, right? Because you're not taking your money out, it continues to compound. Well, you can do that with other assets that are actually designed to be investments.
Yeah.
Investments are, like we talked about, insurance is not an investment. I don't care about the compound interest inside a life insurance policy because it's not an investment by definition.
Yeah.
It's just that compound interest, its purpose by definition is to pay future life insurance premiums.
That's
I
correct.
don't care about that. My goal with life insurance is to protect my family, to buy myself and my family the time to get financially independent and debt free. I just pay as little as possible to buy myself the
For
time
a short,
I need.
yeah, for as short a period of time as possible.
Correct.
Which is that's something you find these agents discussing with their clients is, hey, how long will you even need this life insurance?
No.
Because it kind of defeats the purpose if it is a whole life insurance, right?
Yeah,
Yeah, it actually does.
it does.
Yeah.
So
Because-
that's a great point, because I think that every good life insurance conversation, I hate life insurance, I really do.
Yeah, me too.
I have it and I know that people need it for a period of time, but it's a simple conversation. If I'm sitting with a client and they need life insurance, my only two questions are, how much do you need? And we'll figure that out with them. There's a number of factors, but really the two questions are, how much do you need and how long do you need it for?
Yeah. When
That's
do you
it.
think, when can I get you, how much money can you invest so that you become financially independent? That will answer how long you need life insurance for.
Correct.
Yeah.
Because when the agent proposes a whole life plan, they are assuming you'll be broke the rest of your life and not independent on your own assets,
Right.
right?
Yeah.
Or if they
Or they're
sell it,
planning for that actually. Yeah.
or if they are selling it based on paying the taxes upon death, they're assuming you're gonna build wealth without actually helping you build wealth.
That's correct, yeah.
Right? When somebody's like, well, what about the taxes on your estate for somebody who has $8 in their bank account and a mortgage with
Yeah.
and have their
$200,000
net worth is practically
Is
negative.
Is negative 298,000.
And yet they're selling them an insurance policy to say, hey, you gotta worry about the taxes on death. It's like, well, there are no taxes because they have nothing.
Yeah.
Why don't we help them build wealth first and then
Yeah.
figure that other stuff out, right? I think that's
It's-
a huge priority.
Yeah, so then the other one that I have heard about quite a bit is the participating whole life, which is quote unquote different than the one we just discussed.
Yeah.
Tell us about that.
Participating whole life.
Or the paid up dividend thing.
Yeah,
or whatever it is. 'Cause
participating
I think
whole
those two
life-
are the same, right?
Yeah, participating whole life just means that dividends, there's dividends inside the policy. And really, what's interesting about that is a dividend in the life insurance world is not the same as a dividend in the investment world.
No, it's very different.
A dividend in the life insurance world is basically me saying, okay, Jake, I'm gonna sell you a policy. It costs $9 a month, but I'm gonna charge you 10. And then I'm gonna give you back 1 and call that a dividend.
Yeah,
Does
yeah.
that make sense?
But then what they do with
It's
that
a
one,
refund of overpayment.
Yes.
And then I say to you, Jake, we have a number of options of what you can do with that dollar that I'm
That's
gonna
right.
give you back. Here's your options. And we can either buy paid up additions, meaning insurance that will buy that is paid up and you don't have to pay for that insurance in the future again, or we can do the most common, not actually the least common one is what they call the fifth dividend option, which means, hey, we'll buy with your dividend, your $1 dividend or whatever, to just, in our example, we'll purchase a 1-year term insurance policy for the amount of your cash value. That's the only scenario where if somebody has a whole life insurance and they die, they're gonna get both the life insurance and their cash value, but they're not getting the cash value.
they're just getting that extra
They're just
insurance.
getting extra insurance because they paid for it with their dividend.
Yeah. Now, in terms of cost for that, they call that the fifth dividend. In terms of cost compared to use your $2 million as an example, and that was you said $147 a month that you're paying for that coverage?
For term, yeah.
For term.
Yeah.
And if you wanted that same thing and wanted that fifth dividend option, what would the cost difference be approximately?
I'm not sure.
Because
All I'm-
that fifth dividend is a superbly expensive policy.
Of course it is. Yeah. And it's the same in universal life actually. There's universal life, same thing. If you die, your family's not going to get your cash value unless there's usually two death benefit options in universal life. There's a level death benefit option. That just means if you got $500,000 of insurance, no matter how much cash value you have, your family gets $500,000.
Yeah, it doesn't matter. Yeah.
And then the second one would be a increasing death benefit, meaning you're paying. You actually, when you die, your family gets both, but that's a very expensive option.
Yeah. And the average person making $70,000 to $100,000 a year likely can't afford it, because that'll be at least 10% of their income is going to go to that insurance policy.
Correct. The only way they'd be able to afford it is if it was a very small policy,
Yeah.
which would not be sufficient for their needs.
But then it defeats the purpose of insurance to begin with.
Correct, which
So-
is to protect your income.
And when we say very expensive, you're $147 a month for $2 million of coverage. If you wanted that $2 million of coverage in the whole life specifically, or in the cash value specifically, with that dividend option that we talked about, do you think that it's over $1,000, or is that under $1,000 a month for that coverage?
It's probably right in that range,
Right in that.
because even just a standard whole life was like $900.
Yeah. So you're paying somewhere around $1,000 a month.
Mm-hmm.
And as an example, and my philosophy is 10%. It's biblical. It seems to work on everything. You give 10% of your income, you invest 10% of your income, you will be basically debt free as long as you pay off your debt, and you'll be financially independent if you invest that 10%.
If you
Right.
start
If you
in
start
your 20s
young,
or 30s,
yeah, that's a kind of we should put that in there.
yeah, if you start in your 20s or 30s with the right financial principles, and you invest 10% of your income in good, solid, long-term investments, historically, anyone who does that is going to be in a very good financial position.
And so, by example, so if somebody makes even say $100,000 a year, and they're paying $1,000 a month for a life insurance policy, that's after taxes. That's more than 10% of their income.
Yeah, it's closer to 20.
Closer to 20. So why not just invest that independently, right?
Mm-hmm.
And we should note that there are probably or I shouldn't say probably, there are a lot of agents that are in the term insurance world. All they do is sell term policies.
Correct.
That is also not okay, in my view.
Not
Right?
at all.
You must figure out an investment strategy. If you're having a life insurance conversation, you must have an investment conversation, right?
You have to.
And so if somebody's out there and all they have is a term policy, and their agent never talked to them about anything except term policy, they should probably go and revisit that.
Yeah.
Right. Yeah.
Absolutely.
And so that's the flip side to it, is that the people that believe in term and invest are not the same as the people that only sell term.
Mm-hmm.
Right.
100%.
Right. So that's the other thing that I think needs to be clarified, is that if you are buying term, you must invest.
Yeah.
Right. Because you can't renew your term policy when you're 60, or you can, but it's very, very expensive and you're still healthy. But if you haven't invested, if you've been investing properly, you'll be financially independent at age 60.
Mm-hmm.
Right. And if you're not, then there was something that was misappropriated somewhere.
Mm-hmm.
Right. And so that's the other side of that conversation, is that I have that with clients actually fairly regularly, and people will tell me, yeah, but now I'm 60 years old and I can't qualify because I bought a term. It's like, yeah, but are you financially independent? And if the answer is yes, great, you don't need a policy. I actually had that. Somebody walked in and said, well, we have to renew our policy and it's going to be very expensive, this, that, and the other thing. And I'm like, well, how much assets do you have? And by the time we were done, I'm like, I don't want to sell you. I'd rather not sell you a policy. And they were like, why not? I'm like, because you're actually okay financially. Like, why are we having a life insurance conversation?
Mm-hmm.
Let's have an asset conversation, because you actually have assets,
Mm-hmm.
right? This was 2 weeks ago. Yeah. And so that's the other side of it, is that conversation has to be had very early on. And that's part of the education program, right?
Yeah.
But okay, so we talked about whole life specifically. Let's talk about universal life, what are some of the different things that people see in an IUL that's attractive to them, and how does it get sold?
So the attractive part is the flexibility. A lot of times they'll be sold as your money can grow, but it cannot go down.
Mm-hmm.
As far as the investment portion of things, they see it as, again, a tax sheltered investment vehicle. That's a big part of it.
But when you take it out, it's still taxed.
Correct.
Right,
They
yeah.
they don't.
Like they say,
like
like growth is tax sheltered.
in theory,
Yeah.
right? But in practice, no.
Right.
So it's there's a lot of different ways that it's sold, but I think the big one is, hey, you can get your money into a flexible vehicle, because IUL or whatever, you can your premiums are flexible, right? If you're like, oh, I got some cash value, but my budget's tight this month, I'm just gonna pay less in premium. They'll just say, okay, we'll take less in premium from you, but we'll make up the difference by pulling some out of your cash value. So it gives them the flexibility, so to speak.
Or your investment portion. For the sake of the conversation with IUL, let's call that an investment,
Okay.
right? Out of your investment fund, right? Because
Sure.
in cash value, it's actually just savings, right?
Yeah.
It's not really invested inside a cash value.
Yeah,
For
it's
the
just
sake
got
of
a,
this conversation, right?
whatever, a fixed.
Yeah, but
When you're
inside an
returning.
IUL, a lot of them are actually invested into some type of funds. Or sorry,
They're tied to.
they're
a fund.
tied to a fund. Yeah.
Yeah.
Let's dive down that rabbit hole a little bit, and that's what I wanted to get specific about. Is there, and we'll get into the rest of that conversation in a little bit. But there's a floor and a ceiling. That's why we say it is tied. It is not the actual investment, because the investment itself does not have a floor and a ceiling,
Correct.
right? So, talk about that a little bit.
Yeah, so a lot of policies will say, okay, you're gonna have a yearly renewable term insurance policy, meaning the cost of the insurance increases every year.
So it'll be either YRT or ART in your policy if you're looking at it, right? Annual
Correct.
renewable term or
Yeah.
yearly renewable
Yeah.
term.
Or there is an option of level cost of insurance. I've
Yeah.
only seen that once in my career, because it's very
Very
expensive.
expensive, yeah.
But most universal life insurance policies will have a yearly renewable term insurance policy. Let's say it's for $500,000 for a simple illustration. Okay, so you're paying for a 1-year term insurance policy for $500,000, and then let's say that's $50 a month, and then you're putting, let's say, $300 a month into this policy. So $50 goes to the insurance, and then you pay your fees and all that stuff, and then whatever's left goes to some kind of investment, tied to some kind of investment vehicle. And their claim is, whatever that amount is, let's say it's $200 a month, the first year goes to that investment vehicle. And again, the cost of that insurance is gonna increase every year because it's yearly renewable.
As you get older, your insurance gets more expensive.
And it goes up exponentially.
And
as you get older.
therefore your investment component or your investment portion of your monthly fees goes down,
Correct.
right? So if your $200 is $200 this year, out of your $300 a month, $200 goes into the investment. Next year might only be $150 or $190, let's say.
Yeah. Yeah, and over time it goes up, the cost of insurance goes up exponentially, because the older you get, the odds of you passing away go up exponentially, especially as you get into your retirement years, which is allegedly when people actually need to use the money inside these policies. But that's neither here nor there. The investment portion in IUL, generally speaking, they'll say, okay, we're gonna tie this to a specific fund or a specific index, and the cool thing is you get to participate in the growth, but you won't participate in the downside. But the growth has a cap. So they'll say, let's say the cap is, just for easy math, it's 10%.
But very few are, right? Are there?
No, they quite commonly are. Some of them might even be 12. But let's say the cap is 10 in this case, and the floor is 0, meaning if the market goes up 10%, you're going to get credited 10%. If the market goes up 20%, you're only going to get credited 10% in your account, right? So that's the max that you can return in a year, but the minimum is 0. So that means if the market is negative 10%, you just get 0, right? And that's appealing to people, because
My
to
money is
the
safe.
uneducated investor, their thought process is volatility is bad.
Yeah.
That's the
Well,
average
and it
investor's
gets
thought
communicated
process.
as risk very often,
Correct.
right? And it is. Risk and volatility are two different
They
things.
are.
But anyway, go
Yeah,
on.
that volatility is very conflated with risk in the way that we speak, right? But in reality, they're technically two very different terms. But the idea in these policies is that there's a cap and a floor, and so for when you're selling it to people, it's easy to look at that as appealing, to go, wow, I get to participate in growth in the market, but when markets are bad, I don't have to even worry, because 0 is my floor.
Mhm.
The worst I can do is 0.
My money will never go down in value.
Correct. But that's again a farce, because the return might be 0, but it's 0 minus expenses,
Mm-hmm.
right? And there's a lot of fees and expenses inside of a policy. So even just the fact that they say you can never lose money is a misrepresentation of the facts.
It's actually a lie.
Correct.
And could you maybe explain why that cap is more harmful than it seems? Because they might say, well, the market averages, 9.5%, 10%. So if it's a 10% cap, that's not so bad, right? Can you explain why that's a fallacy?
Yeah, because many of the years in the market returns significantly more than 12%.
Mm-hmm.
And if I'm not participating in that, that's a big deal, right? Like, as an example, if we just go 2021, the market, the S&P 500 index returned almost 27%.
Mm-hmm.
If my cap is 10%, I just missed out on 17% growth. 2020, the market returned 16.26%. If my cap is 10, I just missed out on 6%. In 2019, the market returned almost 29%, right? If I'm not participating in the real upside of the market, that is incredibly costly. Even if I have a floor, right, and it seems so appealing to have a floor on the returns that you can get, even in years that are really bad, like 2008, market's down almost 40%. If my floor is 0, I feel pretty good about that.
Mm-hmm.
But the problem with that is, if I'm an educated investor and I'm dollar cost averaging into my investments, the most exciting times are when markets are down, because I'm able to purchase more assets at a discount during those times. Whereas in a life insurance product, I don't actually own really any true assets.
It's just tied to that index, or it's
Correct.
tied to that investment performance.
It's tied to it. It's not actually in it.
Yeah,
'Cause if it was
otherwise-
in it, it would participate in the full upside and the full downside.
Yeah.
It's not
Well-
actually in it.
Well,
It's
as,
just,
as an example, over the last 50 years, out of the last 50 years, 32 years, the S&P 500 has grown by more than 10% per
Right.
year. 32 years out of 50 years has been more than 10%. So 64, 65% of the time, it's higher than 10%, right? That becomes important to know, right?
So just on the average year, you're already losing money from that cap.
Yeah.
Just on average, let alone the years like you were saying, where it's like close to that 30% mark. Then you're just losing so much wealth there. And not only are they robbing you with the cap, they're also robbing you by stealing the opportunity to invest in the downside, right? So it's a double whammy.
yeah, exactly.
Yeah, well, and the other thing is that like dollar cost averaging for the long-term investor becomes a very powerful tool.
It's maybe the most powerful tool that someone could
Yeah.
have.
Right.
Because
And-
nobody can time the market, right? You and I don't know when the market's gonna be up or down, but if we're dollar cost averaging, we know that we're gonna be taking advantage of those.
And so if you think that the zero floor is a benefit, it's actually hurting you in the long term.
Correct.
Because you never, even though the market went below zero and say it dropped 5 or 10 or 15%, you couldn't participate in buying equities at a lower price because your insurance policy specifically prevented you from doing so. So then you also can't participate in the growth because you couldn't buy things when they were cheap.
Right.
In that same 50 years, there's only been 9 years where it actually dropped. The S&P 500 dropped below zero. I think 9 or 10, somewhere around that, right? So it's like, but when it did, 2002 obviously was a big year, right? It was minus 22, I think. 2008 was that 40%. By the time the year closed, I think it was only 37 that the S&P specifically did, right? And then the latest one was 2022, right? Which was, the average was what was it, about 10% that mutual funds dropped, or equity mutual funds dropped? The average about 10 to 15%, right? So there's been very few years, if you think that that's a risk factor, there haven't been that many. But if you look at that as a buying opportunity, there haven't been enough, right? But you were prevented from the 60 years or the 32 years of growth above 10%, and you're also prevented from buying below zero, the other 10 years that it was below.
Yeah.
In the last 50 years.
Yeah. And you just look at the numbers. If we look at even like a 90-year time frame, 79% of 12-month rolling periods are positive
Yeah.
in the U.S. market.
79 out of 90.
79%.
79%, okay.
Yeah.
Yeah.
Of the last 90 years, the markets have had, the U.S. market specifically has had a positive, and that's month to month, right? Like
Yeah.
January to January, February to February, there's like 900
Rolling
12-month
period.
periods.
Oh, I see. Okay, that's a
over
different
the
math.
last
Yeah,
90
I was
years.
talking about calendar years
But
here.
either way,
But yeah,
and the other thing too with IUL is they don't participate in the dividends of the market, the S&P. But if it's tied to the S&P index, for example, not all of them are tied to the S&P, but just for example, they don't participate in any of the dividends. So for example, they'll use cherry-picked stats and say, oh, the S&P averaged 7.38% over the last 20 years. That would be from 2001 to 2021. The S&P averaged 7.38% before dividends.
yeah,
So then they use their illustration and
That's
compare it,
7%.
and they compare it to the S&P without dividends. If I'm investing actually into the S&P, I get the dividends, and that's an extra 2.14%.
yeah,
So with dividends, the S&P averaged 9.52.
yeah.
So again, it's deceitful.
And now you factor in dollar cost averaging and say that's an extra 1.5% that allows you to dollar cost average into it. You're at over 10%.
If you're dollar cost averaging the same amount through that whole period, absolutely.
Yeah,
Because
right.
you're gonna take advantage of the major downturns like 2008 and 2002.
Yeah, so now you said 9.3 or something like that.
9.52.
9.52, and you add another 1.5%, let's say, you're at 11% rate of return. And my $500 a month in a TFSA earlier was factored at 9%. So you're actually higher. Yeah.
So it's, with IUL, I think it's important to just understand the cost of insurance. If it's a yearly renewable term, your policy is incredibly unpredictable because if the policy doesn't perform like it was illustrated to perform, and again, they very often neglect the fee aspect of things because those fees in these policies are insanely high. Their illustrations oftentimes completely ignore that.
And they don't factor their fees into the illustrations at
No.
all. No.
So unless the policy performs as illustrated, your cost of insurance eventually will eat the policy.
Yeah.
And it will just chew up. And we actually had a scenario in the office here last week where a family had a UL that they had for almost 30 years, and they actually had a decent amount of cash value in it. They have no other retirement savings. They went back to their agent and said, hey, I'm getting close to retirement. I need to figure out how to save some money on my insurance so I can start investing more. This is what they went to their agent for, and their agent's recommendation back to them,
Buy more IUL?
no, it was go on a premium holiday from your IUL, meaning now you're not paying, they're saying you're not paying for this insurance anymore. Yeah, you are, out of your cash
Or
value,
your cash value.
which is the only
Or
savings they have.
your investment value in a YRT, yeah.
Which, and it's gonna continue to increase exponentially, that cost of insurance, because now they're almost 60.
Yeah.
So that price of insurance is gonna go up very quickly. They said, take a premium holiday from that, which is your only savings that you have. And then with those savings, I think it saves them whatever, $400 or $500 a month. You're gonna go and you're gonna purchase a joint last to die whole life policy to cover your estate taxes. That was their suggestion when the client went in asking, hey, how do I save money on insurance so I can invest for retirement, because I don't have any retirement savings. That was their solution. I got an idea, let's go on a premium holiday for this. But the client doesn't realize the cost of insurance is going to go like this.
And they're saying,
and not only that, they don't realize that they're going to be using the $150,000 they have in investments in that policy to pay for the insurance.
And not just the insurance, but also the increased insurance.
The increased insurance, the fees, and all of the policy expenses are going to now be coming out of their investments. So this is where, again, it's all about control. If I surrender control of my dollars to an insurance policy, I'm basically saying, I trust you to follow through and get me financially independent. I don't even have any control whatsoever, right? I always say there's two routes that often will be taken with advisors in terms of your financial plan. A good plan helps you get two things: financially independent and debt free, right? Meaning that you have enough in your assets that produce the income you need to live the life that you want, and you have control of it. If I want to take 20 grand a month out of my TFSA because I have a lot of money in there, I can do that. I have full control. That's option one. Option two is to be financially dependent on an insurance company and to retire on borrowed money.
Yeah. So you're actually giving somebody else 100% control.
Because and in so many different ways, you're surrendering control of your dollars, but then you're also at the mercy of either an insurance company or a bank to lend you the money to live on. If my plan is I'm going to build up this cash value or this IUL or this whole life, I'm going to build that up, and then I'm going to borrow money from the bank to live on because, hey, it's tax free because it's borrowed. I still have to pay interest, so that my money uninterrupted compounding. I can do that. If that's my plan, I am at the mercy of not just the insurance company and the policy working like it's designed to, which, again, all you got to do is just do a quick Google search for life insurance class action lawsuits, and you'll realize they don't always work like they say they're going to work.
Yeah, there's lots of that.
So I'm betting on not being a part of one of those class action lawsuits 40 years from now, and B, I'm depending on the institution to be willing to lend me money. What if the bank can just say no? They don't have to lend anybody money.
Yeah.
If my plan is to build up this cash value and then borrow from the bank, that's my retirement plan. I might build up the cash value, and even if it works, I could go to the bank and they'll just say, no, I'm not lending you the money.
You're too old, and also the bank.
And then what do I do?
Yeah, and also the bank will understand that the cash value in that policy isn't going to be paid out, likely, right? Unless they understand the policy itself. So then they're like, well, we know that cash value is not getting paid out to your beneficiaries. The risk is too high.
And not only that, but the entire retirement plan here, in the long run, is to live off of borrowed money.
Correct.
Right? Yeah. Which from a biblical principle, like we talked about, like in Proverbs, it says the lender is a slave. The borrower is a slave to the lender. Right? So your entire financial plan is to be a slave to the lender.
Yeah.
And I've used that argument before, actually, with life insurance agents who claim to be believers in God, right? Well, do you believe the proverb, borrower slave to the lender? Because if you believe that, you would never sell somebody a retirement plan that's dependent on borrowing money in retirement to live on. Well, that's crazy.
And so to bring that full circle, the idea was first sold as an estate plan so that you don't pay taxes, but then the other side of that plan is to live on borrowed money, so there is no estate to pay tax on if you're going to quote unquote pay estate tax. Right? So the fallacy of it is that you're speaking out of both sides of your mouth, but neither is true. Right? Yeah. On the one hand, you're saying, I can set up this retirement plan tax free for you, but then you're also saying you're going to live on borrowed money. And then on top of that, you are told that you have control.
Well, exactly. Right. They're selling it as, oh, you got more control because you can be your own bank. That's the infinite banking thing. Oh, you're in full control. No, you're not. Right? You're actually depending so heavily on an insurance company and their interest rates on policy loans. Even if I'm not going to go to a third party for my borrowed money and I go straight to the insurance company, what if their interest rate's 10% to borrow, and I borrow $500,000 to live on in retirement? Now I got a $50,000 a year interest bill.
And that's also coming out of
your cash value, unless I'm paying it out of my pocket, which
you didn't have a pocket because you never invested in anything.
Correct. Right. So it becomes this. There's so many problems that when they start to compound on one another, you just have to sit back and just go, why don't I just keep it simple? Why don't I just buy term to protect my family in the time that I need and work like crazy to get financially independent and debt free, so I don't have to worry about, is the bank going to lend me money? Is the interest rate going to be ridiculous when I borrow money? Is the policy going to perform like it says it's going to? Are the fees in the policy going to go up? If they're interest rate sensitive, am I going to be affected? if we can just remove ourselves from that conversation and that concern entirely, that's the best case scenario. Because we've seen too many times, all you got to do is just a quick Google search, life insurance class action lawsuits, and you'll find there's a lot of people who bought policies 30, 40, 50 years ago,
especially during the 80s, right?
Who were made promises that didn't come to fruition, and now they're going, I bet on this. Now what do I do? I'm in my 50s, 60s, 70s, and I got nothing left because I surrendered control to an insurance company and they did not live up to what they said they were going to. And I think that's the most important message people can get from the life insurance perspective. Pay as little as you can to get the coverage you need, and then work like crazy to get debt-free and financially independent so you can kick that policy to the curb. You want it because if something happens to you, you want to make sure your family's still going to get financially independent.
Well, and one of the things that I always talk to clients about, or to people in general, is that it shouldn't be called life insurance. You can't insure a life. We're all going home, wherever that is for you. We're all going to die, right? But you can't insure an income. So it should be called income protection or income insurance. Is what it should be called. Because even in a car, you have car insurance, but you don't insure the car itself. You insure the value of the car, meaning that if your car wrecks, the insurance company isn't going to buy you another car. They're going to give you cash, right? So you insure the value. Same thing is with life insurance. You don't insure that person's life, but you do insure the income or the income loss, right? If
the potential income.
The potential income hit that you would take, That's how I think that conversation should be had.
I agree.
Right, and so...
is there anyone that shouldn't cancel their life insurance plan if they have any of these really bad products? What scenario should they keep it in?
Yeah, I think that's you just need to sit with a good advisor, and they can help you determine that. I've come across a couple situations in the last year like that, where people had these 30, 40-year-old whole life policies. They're not big or anything, but they're totally paid up. They would have been better off having term and investing the difference 40 years ago, but now it's like, hey, you might as well just hold on to that because you're not paying anything for it. They're already financially independent outside of it, and so
it's a secondary item in their
financial plan. It's really just something that's just sitting there, and when they pass away, it's going to pay out.
Their beneficiaries.
To their beneficiaries, yes, they would have been better off having something different way back then, but now it's like, hey, you're better off just to hold on to that. And if it's not costing you an arm and a leg to have it, and it's actually costing them nothing, you might as well hang on to it. But it just is a case-to-case basis. If you're fairly early in the years of your policy, no matter what, sit down with a good advisor who doesn't have an interest in selling you more permanent insurance or just selling you another policy just to make a commission without any real reason to. Sit with somebody and they'll help you determine if it makes sense to surrender it or to.
Well, and the other part of that conversation is, I have seen whole life policies, and you touched on this a little bit. They're called the joint last to die policies.
Yes.
So if you're a husband and a wife, as an example, husband works outside of the home, wife is at home with the kids or whatever, and you have a joint last to die, when the husband dies, the policy is not paying out.
Correct,
Right? And so the policy doesn't pay out until both of you are gone.
Correct.
So those kind of things are actually really important to understand. And the people that I've sat with that had those did not know. When I asked them about it, why do you have it set up so that if your husband dies, it doesn't pay out? And they're like, that's not how it's set up. And I'm reading it to them. It says joint last to die right here. Right? They don't know that.
Even though they set it up for the purpose of protecting his income.
That's correct.
It was his income they needed.
They needed to protect first. Right?
And they both have to die to get it.
They both have to die to get it. Joint last to die. Right? And it's like, why? And then the other thing, when we say a good financial advisor, in my opinion, if you are calling yourself a representative, advisor, whatever you want to call it inside the financial world, you should have both your insurance license and your investment license. Out of all of the insurance reps in Canada, I believe only, like 2/3 of the self-employed, if you want to call that, insurance representatives that actually have both licenses. Is it like 60% or less?
It's
very low. It's very, so I look at that and I go, if you're out there and you're looking for an advisor, or if you're thinking about getting your stuff reviewed, that's actually a question you should ask your advisor. Are you financially licensed for securities and life insurance, or life insurance only?
Yeah.
Right? And so that's the other thing, is how many people that are getting involved in the business side of it as a representative actually know how important that is.
Yeah.
Right?
Yeah, unfortunately, not nearly as many as should. I mean, yeah, you can as a life insurance licensed rep in Alberta, you can use segregated funds, which are also have there's some great
have their
seg funds
place,
out there, but the majority of people don't even sell them if they don't have an investment license. Their primary goal is to just sell life insurance. And again, you talked about it. If that's the only conversation you're having with somebody, find somebody else.
Yeah.
Because life
Or
insurance,
go back to the advisor and say, hey, can we have a bigger conversation? Right?
But if they didn't come to you with that conversation in the first place, you may not want
That's
to
true.
continue
Yeah.
down that path.
Yeah.
Because you want to work with somebody who has your best interests from day one.
Yeah. So
Right.
the segregated funds thing, and we could talk about that a little bit. I don't know that we need to.
No.
We might be running out of time, but in terms of the segregated funds themselves, they have their place. They're a product that has their place.
Yep.
But my point to having your securities license as well as your life insurance license is that you can actually offer a full plan.
Yeah.
Like you can say, if you have both, you can say, yes, your segregated funds make sense at this part of your life.
Yeah.
Your mutual funds make sense over here, this part of your life, right? At least you have the capacity to talk the whole conversation.
Yeah, absolutely.
Because you're not legally allowed to talk about the investment side of a mutual fund if you're not licensed to do so.
And
right?
quite frankly, the mutual funds world and the regulations if you have an investment securities license, the regulations are much more robust, and so there's more consumer protection on that side. Than on
for
just
you as a client, there's more consumer
correct. There's more
protection.
protection for the client, because an investment advisor has standards that they have to live up to that just life insurance advisors, they don't have the same regulations attached to them. And so from a consumer standpoint, you can have a little bit more confidence, because your advisor is going to be held to a higher standard if they hold.
Yeah, you get
both of those
audited
licenses.
regularly. You get looked at, like, why are you advising clients this way?
Yeah, exactly.
Yeah, for sure.
Whereas there's very little of that on the life insurance side, as far as even the segregated fund side. There's not nearly as robust of regulations and compliance, and so that's why I think that's another reason as a consumer why that should be important to you.
Yeah, and we should probably also note that the probate and estate taxes vary from province to province.
Absolutely.
Right.
Yeah.
They're not the same.
Absolutely.
But in Alberta specifically, that is not. And I think I ran a scenario in Ontario one time. If somebody had, and I did this for a specific client, they had a principal residence, so no taxes there. It just gets transferred into the spouse if the one spouse died, because they were both joint tenant. And that's the other thing, is that you should look at all of your registered funds, like your TFSA, RRSP, RESP, your house that you live in. If you have rental properties, everything should be on joint title with you and your spouse, right? Because if one of you dies, the other person just gets it. And the beneficiaries should be set up separately. The TFSA should always have a successor holder where possible. If that's not the case, then at least somebody else is a beneficiary of that, right? But those are conversations that you should have. And so I had that conversation with this couple. I went through everything, and they had a piece of land that was outside of all of those things that was worth at that time about $750,000. And I said, okay, that $750,000 would be subject to probate. That piece of land is going to go through probate. But in that scenario, in Ontario specifically, I think it was $10,000 that they were going to pay in probate fees and so on. And I went, plus there'd be some legal fees, obviously.
Yeah.
But even let's call it $20,000 or $30,000 to be able to scare a client into selling them a $400 a month life insurance policy because of a potential $20,000 bill after you die, to me is it's wrong. It's wrong on so many levels,
I agree.
right? There's no point to it, first of all. Second, why instill that kind of fear? Why not just explain to them how it works? You're 750,000. Yes, your kids are going to have to sell the land. They're going to get even 700. They pay the rest in taxes.
They'll be all right.
They'll be all right,
Yeah.
right? Plus the house, might be worth $1 million, or maybe it's worth 500, and you have all these RSP and TFSA here that are worth another 300 or 400. So all of a sudden they're sitting on about 1.2 million, 1.4 million dollars. They paid 50 grand in taxes.
Yeah.
They'll be all right.
Yeah. And again, I mean,
But it doesn't justify selling a
if,
policy.
if that's your concern, there's more efficient ways to cover that bill.
Yeah.
You could just buy a term policy and invest the savings into solid investments, and then when the term policy expires, if you still haven't died, that investments can be treated like a life insurance policy. The purpose of this account is to pay these taxes. There's so many ways that you can accomplish the same goal. The most expensive way is to buy permanent life insurance.
So the other thing I wanted to talk about a little bit briefly here. How much time we got?
We're at 160.
Yeah.
Okay, we got a little bit of time.
Can I get out of here in like 5?
Oh, sure.
We have a meeting.
Okay, sounds good.
Yeah, sorry.
Yeah, we can just leave it there. That's fine.
Yeah, sure.
But yeah, no, awesome. Thanks for your time. Appreciate it.
My pleasure. Thank you guys.
Yeah, thanks for coming on.
You sure? You're good?
Yeah, we're good.
Okay. I appreciate you guys.
Yeah, I appreciate you coming up.
Thanks for coming all the way up here and setting up.
Oh, no worries. Thanks for wanting to do it a second time.
No worries. I would have done it next week, but we're going to Ireland, so.
Oh, wow.
Let's see
Yeah.
if I'm still recording. Hopefully it can stop.